there, this is Matt Curfman from Richmond Brothers with a early to mid-May 2022 edition of Matt's Minutes. Thank you so much for tuning in. Wanted to reach out and just put some information out there as the markets continue to have really choppy sessions so far year to date, kind of like a whipsaw, I guess. Buzzes up, it buzzes down, and it doesn't seem to have a lot of logic involved right now. So I thought it'd be good to just talk about the overall markets and stocks and equities versus the economy. And so generally, I would say the stock market and the market's mood in general and high level is pretty terrible right now. Although I would add that the real economy, according to the Federal Reserve, the comments just released last week, is actually doing quite well, and our economy is very strong. So what is the disconnect when we have a very strong economy and we have really choppy, moody markets, if you will? And the next question is, so if we're not in a recession, which we're not economically, in fact, the reason the Federal Reserve raises short-term rates is because underlying economic conditions are improving. And yet it doesn't feel like that if you have money invested in the broad stock markets. So one thought I had is just sometimes that fear gets a little ahead or a little out of control before cooler or calmer heads prevail. So we tend to psychologically go to extremes, and generally the logical outcome and really the reality is somewhere in the middle. And we feel a bit that's what's happening in some of the broad markets right now. If you go back to my last 2, 3, or even 4 Matt's Minutes, the 4 things of uncertainty that we talked about pretty much largely remain the same. Those were rising interest rates from the Fed, inflation, uncertainty with the Ukraine and Russia situation overall, and continued COVID risks. There's a lot of shutdowns in China currently with COVID spreading in some larger cities. And so we're not out of the woods with some of the exact same concerns we've been talking about all year. And yet the Federal Reserve now had their second meeting, and they did raise rates a 0.5 percentage point from 0.25 up to 0.75. So we're still at pretty historically low rates. One good piece that I think most economists agree on is that the Federal Reserve agreed to take the extreme rate hikes off the table based on what they know now. There was some concern that they were going to raise too much too fast and push our economy into recession. And so at least for now, that seems to be off the table. But a lot of those 4 items I just mentioned are the same things we've actually been talking about. So right now, if you look at just some context and you look at stocks, even the large caps, really big names, are off pretty considerably. At the time of this recording, the broad NASDAQ 100 represented through some of the big tech companies is off 24 to 25% just year to date. The S&P 500 is off more than 15% year to date. And so what does that mean, and what are some of the names? I pulled up, and this is just a midday representation. Facebook, for example, is a really, really large company. They're off 41% year to date. We've all heard of Amazon and probably use it. They're off 34% year to date. PayPal, online payment transactions, off 58% year to date. Moderna, one of the 2 companies globally that has an approved vaccine for COVID-19, off 46% year to date. Netflix, which I hear from talking to clients from time and again who watch some of the shows on Netflix, really, really large, very popular company, down 71% year to date. So these are not necessarily representative of any one stock in your portfolio, but I wanted to give you a sense of what's happening out there, even with the really, really big companies. So given that, I think we will, or we believe will eventually settle into an environment where the world doesn't fear rising interest rates. And hopefully we get to a world where we continue to move away from the conflict in Russia and Ukraine, both for the sake of the people living over there and also just for better conditions for all in general. So where does this leave us? Economically, we're not in a recession. Stocks feel like we could be in a recession. And if you ever heard the term stock market correction or a bear market, a correction is a 10% dip from previous highs. So the Dow, the S&P, and the NASDAQ have already crossed over correction territory. Bear market territory would be a 20% drop from previous highs, and you're really seeing that in the tech sector, specifically the NASDAQ already. Just for context. So what does that mean relative to your portfolios, and should we do anything about it? So a couple of reminders. One, we've worked with a lot of you over the last handful of years on just narrowing in and honing in on your comfortable risk score. And that risk score and risk tolerance, if you recall, is a range from 1 to 99. Closer you are to 1, the more conservative you are in your portfolios. The closer you are to 99, the more aggressive you are. The broad benchmarks like the S&P 500 and the NASDAQ would be about a risk 75 or 76 for context. So if you have a portfolio that's a risk 35, you're not as risky as the market. You're not completely immune to some of these swings either, because a well-diversified portfolio is going to have some equity exposure. You're going to have some bond or fixed income, maybe some cash, and maybe even some guarantees such as fixed equity indexed annuities. A lot of those come in closer to that risk, 1. So just continue to work with our team and your advisor on just your overall risk score to make sure you're comfortable. And then additionally, I think it's still really important to be diversified. So back when the tech stocks were doing really well, it was hard to own a guaranteed safe asset that might have only made 1% or 2%. But those same safety nets are there now when those markets are dropping 10, 15, 20%. So being balanced, being diversified is really, really important. And that'll help us get through the other side. So at this point, we just want to make sure as we talk to each and every one of you individually, we're not comfortable with where we're seeing the markets and just some of the swings. That said, we don't see the economy tipping into recession. So there seems to be a bit of a disconnect. And we don't know how long this will last. It's more of the market mood seems pretty off right now. That doesn't mean it'll stay there. And for all intents and purposes, you can look back and, 2020 in March was when we first had the big sell-off for the pandemic, 2008, 2009, also a big recession, and declining economic conditions. And then 2000 to 2002 were the last kind of big major routes. We also have reason to believe we're going to see, we think, some stability now in more of the fixed income and the bond markets. There's been an initial shock that has caused some downward pricing pressure, we think temporarily. And now that we are kind of settling into a world maybe of rising interest rates, we think that'll be a good area to continue to have some exposures dependent on your risk tolerance. So we are here to help inform, to help educate, and to help guide you through no matter what is going on in the world and around us. Thank you so much for being part of the Richmond Brothers family. Thank you for tuning in. And if you are tuning in from the Midwest, just over the weekend, Mother's Day weekend, that is, we started to have some really nice sun and blue skies, which I'm sure we have all been missing very much. So take a step outside, take a walk, get some fresh air, and we're here to help. So don't hesitate to reach out. Appreciate you tuning in.